In this video, I will show you the ultimate stock tier list if you want to invest in stocks for the long term. You want to pick great stocks, you want to build a strong portfolio that will compound your wealth for the long term, then definitely this tier list will be helpful. It will show you the stocks you should completely avoid, and it will show you the stocks you should focus on. I will give you specific topics, specific categories, specific names, specific stocks, specific companies, so you will get a lot of value out of this video. In case you are new to this YouTube channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. So I focus mainly on these tiers like S tier, A tier, B tier, and I recommend you do the same. But let me start with the worst kind of companies, the E tier. And if you want to invest in stocks for the long term, you want to absolutely avoid these kind of stocks. These stocks could be penny stocks, SPACs, so speculative companies, hype niche. We've seen the example right now with quantum computer stocks. These stocks just have great momentum for 3 weeks and then they crash and burn. And I'm putting in this category unprofitable companies. And I have a couple of examples to show you the kind of stocks you absolutely want to avoid. The first example for you is Nikola Corporation. And if you don't know what Nikola is, I will show you. It will be the way I will present companies in this video. I will show you the website GoalFocus. You will have a description of the company. Let me put my face here. Nikola is a technological innovator and integrator working to develop incentive energy and transportation solutions. This is an EV company. Okay, they work in the EV industry. And you see that this is a small company. Okay, very well. And if you scroll down on GoalFocus, you can check the financials of the business. And the reason number one why I think you should avoid the company is because of fundamentals. We are stock pickers, fundamental investors, long-term investors. We don't want to avoid in unprofitable businesses. So if on the website GoalFocus, if you go to revenue, you see that for the revenue growth, you don't have much of a track record of a growing company. For net income, you see losses every year. You see a negative net income. So as the company is growing, the company is having more losses. So literally burning cash. What about the cash flows of the business? You look at this, free cash flow is always negative. And the company now has some debt. And you want to avoid this one because it's very likely that in the future they will continue to have losses. And for the stock price is very strange for this one because I believe the company IPO'd in 2020. Here we go. And it was a stock price of what, 1,000, and then it went up to $2,000. Purely speculative people buying the stock, gambling on the stock, and then the stock collapsed from $2,000 to $1. So if you believed in their story at $700, $600, you would have lost all your money. Basically, this is the kind of worst case scenario you want to absolutely avoid. And now an actionable tip for you, so you get some value out of this video. If you believed in their story at the moment when they IPO'd, when they went public, they released an investor presentation showing, okay guys, we are now a public company. Here are our forecasts for the coming years. We think we will deliver this amount of products, services, we will do this and this, and we will become profitable at this stage. Normally, that is the reason why you avoid IPOs. You have a lot of promises, but after 1 year, 2 years, 3 years, no operations, the management is struggling, the company is struggling, the industry is struggling. That's a complete mess. And if you had invested in Nikola for the past 3 or 4 years, you would have lost all your money. So definitely the kind of situation you want to avoid. Hype niche company going public with no earnings, no track record. This is absolutely the worst case scenario. And you have here the same phenomenon happening with AMC and GameStop. These two are meme stocks, and a lot of retail investors gambled on these stocks because of hype. They made a movie out of GameStop and the short sellers. You don't want to be involved in this, because I recall you that this video is for long-term stock pickers. And I'm telling you, if you invest in these names, you will have a lot of stress. You will not sleep well at night. This is not what you want. These are struggling companies, not growing companies. They don't have much free cash flows. They don't have much profitability, efficiency. These are bad businesses. And there is a momentum around these stocks for a couple of weeks, and then it fades out, and you saw the effect on the stock price. The stock price collapsed 99.95%. So absolutely horrible performance. Same thing for a SPAC, Virgin Galactic. When you see a SPAC, when you see a hype, a lot of people on YouTube, Twitter talking about the same stock, and you do your own due diligence, and it turns out that this stock is associated to a bad company with a lot of losses, bad management, bad company, just avoid. And if you in the future, if you leave this video and in the future you continue to do your own due diligence, if you encounter this kind of stock, please don't spend more than 10 seconds analyzing it. You just check this chart, this criminal chart I showed you with the revenue and the losses every year, and you can just extrapolate this trend. Don't bet on a reversal. It's very likely that it won't happen because this company is bad. You never know, but if you speak in terms of odds, it's very likely that you will lose money on this one. Okay, let me continue. So this was the E tier companies to absolutely avoid. Okay, now let me talk about the D tier. So bad business and or bad management. I'm putting here Intel, that is known for struggling in this difficult industry. And what is funny is that you had the book Only the Paranoid Survives about Intel, and it turns out that they were not paranoid enough, and they got killed by competition. So it's a big company in the US. They have a lot of trademarks, yes, but in terms of growth, efficiency, profitability, market share, they are struggling, and they failed at almost all their innovation for the past 10 years. So this is some bad capital allocation, bad decisions, and they changed management a lot. There was a new CEO every 2 years. I mean, now as I'm speaking, January 2025, there will be a new CEO for Intel for this year. So you don't want to invest in Intel for these reasons. This is not a stock that you completely have to avoid, because this is still a big company and they can still make some money in the future. They can have a new CEO that is a prodigy, but be bearish. But there is a growing debt, revenue is collapsing, net income is collapsing, free cash flow is a complete mess. Free cash flow is now negative. They did some buybacks in the past, and now they are diluting shareholders. The stock has only gone down for the past 10 years. A lot of hope and a lot of deception, and a lot of hope and a lot of deception. So no, a lot of disappointments for the stock so far, and I don't think this trend will continue, will reverse for the moment. Maybe I will be wrong, but for the moment. So definitely a bad company, bad management, bad capital allocation in a very difficult industry. This industry is very hard. Same thing with the GE. I mean, this was a big conglomerate in the past, and now they became too complacent. So this is the same thing. Bad business, bad management. If you want to invest in the long term, meaning you want to compound your portfolio 10, 15, 20% per year, this is definitely a stock that I would completely avoid. Same thing with Bed Bath & Beyond, bad company. WeWork, that went bankrupt. And Boeing, you know it. Most of the audience I have is from the US, so you know that Boeing is having some difficulties right now. And it turns out that this planes industry is very cost heavy, capital intensive. You always have to innovate and reinvest your cash flow to just have some maintenance costs and some innovation here and there. You have some scandals. Maybe you don't want to be associated with Boeing. The management has made some issues mistakes when it comes to security in comparison to their biggest competitor, Airbus. So if you want to invest in great companies to build a great portfolio for the long term, I would recommend you avoid this one. I have never invested in this kind of businesses, and if I had, I would have lost a lot of money. WeWork was a complete fad for a few years, and Adam Newman, the CEO, the founder, was helped by Masayoshi Son, and they pumped some money and they invested a lot of money in WeWork, and they completely lost everything. So that was for the D tier. Now you know the stocks to completely avoid. E tier is for retail investors, also called monkeys on the internet, meme stocks, etc. These are not serious investors. Come on. And D tier, struggling company in a difficult industry. You can expect more suffering. These are two different kind of businesses. Now let's go to the C tier. The C tier is the average business. I'm putting here Ford, AT&T, Kraft Heinz, General Motors, GM, and Alibaba. These are not spectacular businesses, but not bad. So let's put them at average business. And if you look at GM, for example, General Motors, you can have some decent returns if you invest in this stock, because this is okay, a well-run company. They have some cyclicality, but this is fine. You just have to concentrate on the price you pay. You have to focus on the price paid for this stock. In other words, you don't want to invest in General Motors when you have a lot of growth priced in, when you have a lot of price here in 2021. You want to invest when this is pessimistic, and when you are in 2023, you can have some quick returns, quick gains on this one. But you see that for long-term investing, this is maybe not the best opportunity. Over the past 10 years, the stock has only gone up by 15%. And if I look at all, you have a lot of stable operations over time. So it's not a bad business, but it's not a great business that you should own for the future. They have some debt, they have no growth in revenue. Look at the revenue in blue. No growth in revenue for the past 10 years. Net income, no growth in net income. Free cash flow, they are losing money, losing free cash flow every year. Okay, please do your own due diligence on this one. And now they are doing some heavy buybacks, and they have small dividends. So that's fine. That's just an average business. Same thing for Ford. It's a very difficult industry, but they are doing okay. They have been investing heavily in EVs, and they are struggling and making and losing money on electric vehicles. But this is okay. I would not say that the management is bad on this one. It's just that they are struggling, but they are fine. I mean, you can't go bankrupt for these companies. They won't go bankrupt. I'm also putting Alibaba to this list. Alibaba has been a disappointment for a lot of investors. I'm an investor in Alibaba, and I've been an investor in Alibaba since 2018. So it's been 7 years now. I know what I'm talking about, and most of the sentiment we had towards Alibaba is disappointment. The company is big. The company has lost a lot of market share. Now the company is struggling. The company is struggling to grow again. This is becoming a big behemoth. So it's an average company. They kind of lost their moat. The stock price completely collapsed. The growth stopped. The net income decreased and never recovered. They have a lot of cash, and they produce some good free cash flow. But that's it. Seems like the business was killed by competition. In terms of efficiency, you can look at the ROIC, the return on invested capital. Here you see that the ROIC decreased, and now the ROIC is about 6-7%. We are not talking about a highly efficient company. It's a big company, asset heavy. So they do some buybacks, they give some dividends, they have some cash, they are still profitable, and I will completely put them in the average business category. Okay, so something that I would focus on if you want to invest in these opportunities is the price paid. You want to have a big focus on valuation. You want to avoid this kind of stocks when they are expensive, and you want to buy them when they are cheap. But maybe it's not the best kind of opportunities you can have in the future if you want to invest for the next 3 years, 5 years, 10 years. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Now let me move on from the C tier to the B tier. And now we are going into the interesting level, okay? B tier, these are good businesses with a decent moat and a good management. Let me remove this and show you what I have. Nike, Procter & Gamble, McDonald's, Adobe, Coca-Cola, Games Workshop. All these companies don't have an amazing moat, wide moat. Maybe the best moat out of this list is Games Workshop. They are not exceptional, but these are good businesses. They continue to grow, they make some money. Maybe some of them have temporary problems, but that's fine. I mean, for Nike, it's a good example right now because the stock is crashing. Nike is still a good company. It's one of the top 20 brands in the world, and Bill Ackman bought the stock recently. There is some interest in the stock. This is a company worth $100 billion, and the stock has gone down back to 2018 levels. So definitely something to monitor. The goal with this C category, what is that, B or C? B tier category, is that you want to buy them when nobody's talking about them. You want to buy them when you have some pessimism around the stock, which is exactly what we have right now with Nike. So maybe right now is a good time to buy Nike. I'm not a fan of this industry, so I have no strong opinion on this one. But if you don't buy Nike now, when do you buy? The company is still growing. The net income is still fine. They have a new CEO now, and they still produce some strong free cash flow. Free cash flow has been growing. You see some cyclicality here and there. That's fine. And in terms of efficiency, if you look at the ROIC, it's above 20%. They do some buybacks. They have some debt, but that's okay. And the PE ratio, the valuation, is around 20-30. So yeah, maybe you can expect lower earnings for 2025, but nobody knows. And we will see what the new CEO will do. So definitely a good business, a lot of temporary issues. If you know Nike, if you know this industry very well, this is maybe your time to shine and your moment to invest in this one. I'm not an expert about shoes, sports apparels, so I won't touch the stock, but maybe you are. So maybe this is a good time for you to do your own due diligence. So we are talking about a good business with a decent moat. It's not a very wide moat. You have other shoe companies right now that are getting some market share from Nike, but decent moat still, and a good management. Now the management came back. We had, the CEO of Nike over the past 3 or 4 years was a consultant from Accenture, I guess, a consultant from ServiceNow. So I guess if my memory is correct, he worked at these two companies in the past, and he didn't work at a shoe company. So now he was kind of fired, and now a new CEO is coming. A new CEO, a Nike expert. So maybe the spirit, the culture of Nike will come back, and we will have some extremely good growth, especially since Bill Ackman, one of the best investors in the world, bought a position. He bought a position around here, I guess. So now the stock has gone 20% lower. If Bill Ackman is getting interested in a stock, that's a very good moment to do some due diligence. So he spots some good opportunities. The brand is still here. The moat is still here. The vision is here. So maybe that's a good opportunity at the moment. That's definitely a good business, decent moat, good management. Procter & Gamble, I put this in the same category. McDonald's follows the same category. You won't have exceptional returns when it comes to McDonald's, but that's fine. This is a big company, $200 billion of market cap, PE ratio of 25. Everybody knows McDonald's. The stock has been doing good stuff up and to the right. Strong margins, some efficiency. They have some debt. They focus on long long-term leases. So maybe this is not real debt, this is the debt for leases. The free cash flow is here, going strong. ROIC about 20%. About the revenue, I'm not sure. I don't know McDonald's that much. Net income is going up. They do some buybacks. I would not personally be interested in McDonald's because this is not my kind of investments, but definitely something to monitor in the future. Price to free cash flow of 30, PE ratio of between 20 and 30. You can't kill McDonald's. You had quick service restaurants alternatives in the past and they couldn't kill McDonald's. So I think McDonald's is very well positioned to be here in the next 10 years, long-term investing. Adobe, same story compared to Nike. You have a lot of uncertainties, a lot of temporary issues, and now with AI and image generation, people are thinking that the moat is eroding for the moat is eroding for Adobe. Maybe it will be the case. Nobody really knows. I can just have an opinion on this one. This is a great business, very high margins, recurring business. They have a lot of growth. Most of the cash is going into buybacks. The problem with Nike is that they don't have much reinvestment opportunities. They are the leader. They have some clients. They pay a monthly fee to have their services. You have 3 different segments when it comes to Adobe. And revenue is growing in blue. Net income is growing. Free cash flow is growing. I mean, life is good, and you are talking about an efficient business model. Yeah, this is a software. ROIC of 20% or more, and most of the cash is going into buybacks. They don't have a debt issue. PE ratio is between 20 and 30. That's fine. That's a fair value. Gross margins extremely high. So that's the story for Adobe. If you are an expert and if you use Photoshop or any Adobe product, maybe this is your time to do the due diligence and find this one. This is definitely a good business. I have some doubts when it comes to the moat, to be honest, and I'm still doing some due diligence on this one because this is a wonderful company, and we'll see. The management has been here for years and years. They know how to deal with issues. The only worry we have right now when it comes to the moat is AI, image generation through AI. But definitely a good business, decent moat, good management. Coca-Cola's story is very similar to McDonald's and Games Workshop. In case you are not familiar with Games Workshop, this is a company that sells figurines in the UK, soldiers figurine of the franchise Warhammer 40,000, and I've been following the stock since 2020, so I know the company really well. They have only 3 factories in the UK. They are starting to build a 4th factory to build these figurine soldiers, and it turns out that this business has a very decent moat, I would say. The fans, the customers are hardcore fans. They love their products. There is a sense of community when you build your own army of soldiers and you can paint your own soldiers. You have the IKEA effect. And to that regards, the revenue, earnings, free cash flow, everything improved with the new CEO, Kevin Roundtree, in 2015. So you see here that there was a change in 2015, and revenue, this is in blue, is going up and to the right. Net income is going up and to the right. They have not a lot of debt. They generate some strong cash, and half of the cash is paid to dividends. Maybe this is something you may disagree on. You want more buybacks, but this is a UK company. So European companies, they don't. I mean, I'm European. I'm French, so I know that we don't like we don't like buybacks. Maybe the culture in Europe is more about dividends. That's the culture. You can't change culture. Efficient business and PE ratio between 25 and 30. So not a cheap price for a figurine company, but definitely something interesting. They sell their figurines through retail, through their own stores, through online stores. They have some IP licenses. They will make some series on Amazon Prime with their franchise, with their IP. So definitely an interesting story. Not for everybody. You have to be a gamer, video gamer, a fan of these figurines to invest. But luckily, I play a lot of video games, so I know exactly how this works. Good company, decent moat, good management. I would say that if you invest in these companies for the long term, you can have some pretty good returns. I mean, I know Games Workshop really well. So if I want to invest in Games Workshop, I would have outperformed the European index. I would have outperformed the S&P 500 if I had bought here. But I was a teenager at this time, so I couldn't buy at this point. And yeah, if you are a shoe person, you know a lot about On Holdings, Nike, Adidas. You know the difference, you know the management, you know how they operate, so that could be interesting. And in case you are a fan of Adobe's products, if you use Photoshop or other products, Adobe Premiere or video editing, you may be interested in buying this one. And this list only has 6 names, but you can add as many names as you want. This is a B tier. These are good businesses. They can continue to grow in the future. They will be better in 5 years, 10 years. They have a track record. They have history. The management is solid. The capital allocation is solid. The growth is here. The efficiency is here. You don't see many red flags for these businesses. This is why I say these are good businesses. And now we are going to the A tier. So better businesses. They have a wide moat. They are better than competition. They have a great management, and there is a strong growth potential. So what are these stocks? Let me show you. These stocks are Amazon, or you have an example with Ferrari, Meta Platforms, or Facebook, Alphabet, or Google, Nvidia, or JP Morgan. I have a list of 6 companies. These are great companies that have shown over the past decade or even more decades that they are superior to competition. They have a lot of growth, and they have a lot of growth ahead. There are a lot of efficiency, the management is brilliant, and it's very likely that these companies will do well in the future. I don't have to explain why Amazon is great. They are everywhere, they are efficient, they are growing fast. And as the TAM, as the total addressable market, the TAM increases, Amazon will continue to increase. They are the leader in many categories. Same thing for Ferrari. The moat for Ferrari is great. They have a buying list, shopping list, a backlog of 2 years. So all their cars are bought. They have no supply problem. They have no demand problem. This is a business that can't be killed. And in 30 years, I believe Ferrari will be here and their cars will be even more expensive. They have an amazing pricing power. They can increase the prices of their cars and still people will buy them. And the only worry I have with race with Ferrari at the moment is the price of the stock. It was never cheap. Now the PE ratio for the stock is above 40. The only question I would have for Ferrari is at what point should you buy it? What is the valuation you would buy it? Ferrari was a spin-off from Fright Chrysler in 2015 and they IPO'd and went public, and the price was always high when it comes to valuation. I'm not talking about the stock price, I'm talking about the valuation. From a PE ratio perspective, the price was always high. Even here in 2022, the PE ratio was, I think, above 30. That's maybe your best opportunity. You won't be able to buy this business at a PE ratio of 15. It's a superior business model. They have growth runway. The future earnings are secured, and for this reason, you pay a premium. The margins are exceptional. They have some good capex, but still they deliver strong free cash flow, strong efficiency. They don't have much debt, and as inflation picks up in the world, I believe the prices of Ferrari cars will increase drastically, and that will lead to better earnings for Ferrari. So definitely a white moat. The Ferrari culture is here. Great management. They know exactly what to do. They don't want to flush the market with cars. They are very selective. Strong growth potential in the future. Yes. Same thing with Facebook and Alphabet. These are the leaders of the world. They are everywhere. They have billions of users. They have a lot of efficiency, very high margins, a lot of growth. And as the world is spending more time online, as the industry of digital advertising is growing, these businesses will make more money. And they can monetize their tools in a lot of ways. For Meta platforms, they can still monetize WhatsApp, that is not very well monetized at the moment. They have the VR headsets that someday they will be able to monetize. They will continue to add more ads in Instagram, Facebook. They will have some pricing power from advertisers. So I don't worry for Meta platforms. I don't worry for Mark Zuckerberg. Great management. I would say Mark Zuckerberg for Facebook is in the top 5 CEO of the world, and he's only 40 years old. So he has the vision, he has the efficiency, and he's hungry for more. So the CEO is young, and you can take advantage of it to invest for the long term in Meta platforms. Similar to Alphabet, the CEO is not the founder. Sundar Pichai is here. A lot of efficiency. Google is everywhere. You are watching this video on YouTube. It's very unlikely that YouTube will collapse in the next 5 years. I think they will continue to improve and make more money in the next 5 years. You can't kill them. You can't kill the wide moat businesses. It's very difficult, especially now, since we have some regulation. In the past 5 years, regulation has increased drastically when it comes to social media. So it's very hard now for a small startup to come and compete with Meta platforms and Google. The barriers to entry are just astonishingly high. You can't compete with them. And because you can't compete with them, advertisers, promoters are forced to go to these two platforms, and they can put whatever price they want. It's a bidding auction, and they will make a lot of money. So that's it. And when it comes to price paid, I would say even now, the price is good. The PE ratio for these two companies is between 20 and 30. So below what the S&P 500 is trending at. Now the PE ratio of the S&P 500 is around 30. Okay. And these two companies that are better than average are trading at a cheaper valuation than the market, which is absolutely no sense. The PE ratio for Meta platforms is between 24 and 28. So you get a cheaper valuation for a better business. You can sense the risk-reward attractiveness. That's a beautiful opportunity here. They have a lot of cash. They do some buybacks. They rebounded sharply from 2022. Management with a great vision. So that's an amazing company, and I believe these are trading at an attractive price right now. Same thing with Nvidia. Clear leader in the market, clear visionary CEO. The runway is immense, and if AI is really profitable in the future, Nvidia will make a lot of money. The growth is extreme at the moment, and maybe the growth will continue to be extremely good in the future. So definitely a A tier category, maybe S tier. Nvidia is at the frontier of these two. Now JP Morgan, same stuff. Driven CEO, great management, great efficiency. I believe this is the best bank in the world. And Jamie Dimon has done a phenomenal job of managing risk on this one. This is maybe the biggest bank in the world. The market cap of this one is $700 billion. The valuation is okay. PE ratio of roughly 13, 14. Nice margins, nice efficiency. They do some buybacks. They think for the shareholders. The revenue is growing again. The net income is growing. They will hedge against many risks. The efficiency is here. The return on equity is around 15, which is great for a bank. And if you look at the stock price, it follows the economy. It's even better than the S&P 500. And if you invested in JP Morgan, you would have outperformed the market. So you want to invest when nobody trusts the bank. And yeah, this is some great performance. I believe in the future, JP Morgan, as it has some scales and as it grows, I think it will become more powerful. So now you see that in the A-tier category, we are talking about great businesses with a wide moat, with a great management, with a long runway of continuous improvement, a lot of efficiency, nice margins. This is maybe the best kind of investment you can make for your portfolio if you invest in stocks for the long term. The only thing that matters is, are you familiar with the name? Do you know the company really well? Do you understand the vision of the company? And are you aligned with them? Are you aligned with the vision of Meta platforms, Google, Nvidia, etc.? And if you like the idea, you can buy them. And I would say that some of these, you have seen it with Meta platforms and Google. Some of these trade at a normal valuation, reasonable valuation. Some of them trade at an expensive price, like Ferrari, PE ratio of 40, but Meta and Google, they trade at a PE of 25 approximately. If I check Google right now, you have a PE ratio as of today of 25. Between 20 and 25. So definitely not expensive. And you have beautiful margins, beautiful ecosystem, no debt whatsoever, growing earnings. So these are the kind of opportunities you want to focus on if you want to build a great portfolio filled with great companies for the long term. But you have even better investments. This is the S tier. We are talking about an extremely wide moat with business models that are impossible to kill. So this is very likely, like 95% chance, that there will still be dominant for the next decade. This is the kind of businesses, literally, competition can't come and compete with them because they are so far ahead. This is phenomenal. Let me remove this. Okay. You have a couple of names here. Texas Pacific Land. They own lands in Texas. Fair Isaac Corp. They are a monopoly in the scoring business in the US. Visa, you know it. That's Visa, MasterCard. You have the duopoly for payments in the world. If you believe that more people will pay with their cards, Visa and MasterCard are very likely to grow. Berkshire Hathaway, the amazing conglomerate of Warren Buffett, unlikely to be killed in the future. Costco has built an amazing flywheel for more than 30 years now. And Moody's. Moody's was impacted in the crisis of 2008. They were in the eye of the storm and they survived. And now the business is thriving. So if you are hit by the worst crisis ever for your industry and you survive, that proves that you are essential to the economy. You are essential to the world. You can't kill Moody's. And because I talked about the brand of Ferrari, you can add to this list Hermes, our French luxury name that has been here for centuries, and because of what they have built, they are very likely to be here in the next 50 years with more expensive bags, more expensive products, services, high-end luxury names. So let me take some examples here so you can understand my point, why these businesses are impossible to kill. Let me start with the first one, TPL, Texas Pacific Land. I think TPL is the best business model I have ever seen. And I've seen a lot of businesses. TPL has been here since 1888. It's been a while. And they own some lands in Texas, in the Permian Basin in Texas, in the US. That means they own approximately 900,000 acres in Texas. It turns out that on these lands, you have some oil that you can drill. You have some water usage, like bad quality water that you need to cool things off, to use to produce oil, to treat oil. And this is what they do. They manage these lands. They allow other people to come to their lands and manage the lands. So TPL doesn't drill the oil itself. They don't manage the water. They have some contracts with oil drillers, oil companies, for example, ExxonMobil or Chevron, ConocoPhillips, and they say, okay, you want to drill my oil? Okay, give me a 3% royalty. That's it. That's the end of the business model, basically. And if you are a royalty business, you don't have a lot of costs. You have extremely high margins. Look at this, 90% gross margins. The only cost that TPL has to pay is the cost to employees, the salaries. It was a trust in the past, so in terms of management, they had some extreme salaries. Now it's a little bit more rational, and that's it. As the oil price goes up, you have more royalties, revenue. You have more money. If the oil production is increasing in the US, as Trump would say, drill baby drill, you have more drilling, you have more royalties, revenue. So you have more revenue, and if you have a 90% gross margin, you make a lot of money. And this is exactly what they do. You have no debt whatsoever, no cost whatsoever. Revenue is up and to the right, net income is up and to the right. They produce a lot of free cash flow, and now they pay some dividends. They did some buybacks in the past, and now they do some dividends. Fine. They reward shareholders, accumulate cash, and the stock price has been a 30 bagger or even more for the past 10 years. I've known the company for many years, and this is a phenomenal business model. Now the valuation is a bit expensive. You have a PE ratio between 50 and 60, so a bit expensive. And to be honest, I bought the stock, let me put 5 years. I bought the stock here in November 2020, and I sold the stock at the peak at $1,600. So it was like a 8x, 9x for me. And for the moment, I'm waiting for the stock price to drop so I can buy again. That's it. You can't kill them. They have been here since 1888. It's very likely that we will continue to use the Texas lands to drill more oil. It turns out that in these Texas lands, the cost of energy is minimal when it comes to gas, so it's a perfect land environment to build solar panels, to build data centers, to build water resources, water management plants, facilities, roads, infrastructure, and TPL will do nothing. They will just receive their royalties out of this build out in Texas. So if you want to continue doing your own due diligence on TPL, I made some videos on my YouTube channel. You can check what their biggest shareholders have to say about TPL. The biggest shareholder of TPL is Horizon Kinetics, Murray Stoll, one of the best investors of our time, and they have been investing in TPL for 30 years or more, and it has been a beautiful investment. Sometimes you only need one. You only need one investment that will compound and grow your portfolio for the long term. I believe TPL is one of them, and I believe the runway for land management is amazing. Texas will still be here. The Permian Basin, where they are situated, is one of the best basins in the world when it comes to resources, commodities. So we will see. And now they own land, they have zero cost. If you think inflation will be here in the coming decade, okay, they will have zero cost. So the margins will stay at 90%, like very high margins. It will be added up to the top line. Inflation will grow their revenue. Amazing stuff. Same thing for Fair Isaac. They are clearly in a monopoly. In the past, some companies have tried to disrupt them. You had in 2014 the Vantage Score. You had Upstart in 2020, 2021. I mean, in the past 10 years, some companies have tried to disrupt, to kill FICO. And it turns out that you can't kill FICO. The stock has been on a run recently. The stock is expensive right now, but it was not always like this, so it will come back to reality. High efficiency, high growth, revenue growth up and to the right, net income growth up and to the right. The debt is not an issue. I mean, it's only 2 billion compared to market cap of 50 billion. So debt is not an issue. They do some buybacks. They generate a lot of free cash flow. They use all the free cash flow to buy back their own shares. Amazing. They have an immense pricing power. And if you want to get more information about Fair Isaac, I can recommend another investor, Dave Contesaria from Valley Forge Capital Management. Type this on the internet. You will find a fund that is invested in fewer than 10 names, and their biggest position is FICO, is Fair Isaac. Dave Contesaria, Valley Forge Capital Management. Great investor, great fund, great performance, great company. This is you only need one. Maybe you need two, TPL and FICO. That's it. You have done your due diligence. Now I would not buy them, and because they are expensive at the moment, they have a PE ratio between 60 and 90, but a few years ago, the PE ratio was 20, 25. But nobody was interested in buying the stock now. So it's all about cyclicality. You can buy them when they are trading at a reasonable valuation. Fair Isaac definitely in the impossible to kill pile. Visa and MasterCard, I don't have to talk a lot about these two businesses. They have been there for years, for decades. If you believe the growth of the world will continue, if you think GDP growth like globally will continue, Visa and MasterCard are very likely to be the leaders. Berkshire Hathaway, you can't kill this big conglomerate. Even after Warren Buffett will pass away, you will have Greg Abel as a new CEO that will do great stuff for the company. I mean, in terms of operations, Greg Abel is marvelous, fantastic. Same thing for Costco. They have built a beautiful flywheel over the past decades. This is maybe the best company, favorite company from the late Charlie Munger, his favorite company. He was a member of the board. The market cap is $400 billion. Revenue is going up. Net income is going up. Look at this. Revenue going up. Net income is going up. They don't have much debt. They grow their free cash flow every year. They do some dividends. They are highly efficient. They have roughly 15% ROIC. That is fine. And the business model is a beautiful flywheel. It's an economies of scale, membership program, recurring revenue program that you can't disrupt. You can't disrupt the culture, the spirit of Costco. And they have some good pricing power. They can increase the membership revenue, the card price, the membership price, yearly price, and that's fine. And now the PE ratio for Costco is around 50, so it's a little bit expensive, but it will come back to reality eventually. But again, you are not forced to buy it now. I mean, if you were there in 2017, 18, it was not so long ago. You could have bought the business and you would have enjoyed the run. So that's good. Moody's, same stuff. I told you about being in the eye of the storm. Inside the eye of the storm, you can't kill Moody's. SPY, Fitch, Moody's, all these companies are great and essential to the US economy. So you can't kill them. And I added Hermes to the list. Hermes is a company that has been here for so many times. That's the French culture. That's if you want to invest in French culture, luxury French products, you invest in Hermes. And I believe this is recession resistant, great margins, 70% margins, great backs, great branding all around the world. They have no debt, revenue is going up, net income is going up, they have a lot of free cash flow, they have a lot of efficiency, they don't care about inflation, they don't care about interest rates, they don't care about competition. They do what they do best, and it works because they don't change their culture because of the world that is changing. They just focus on one thing and they do it well. And it turns out that this is very, very profitable. And they do that with a lot of efficiency. So you may think that PE ratio of 50 is expensive for this business. You will see that this category of S tier businesses, most of the time they trade at a premium to the market. I'm sure that is what you are thinking right now. And I may disagree with you, because I told you Fair Isaac was trading at a PE ratio of 25 a few years ago, like in 2022, so 2 or 3 years ago. It was the same business model. TPL was trading at a PE ratio of 20 in 2020. They were trading at a PE ratio of around 20, 30 in 2023. So 2 years ago, you could have bought this big, beautiful company. Same thing with Fair Isaac. Visa right now, they have a PE ratio of 30. That's reasonable. I mean, that's not 60, and you can pay 30 times earnings for this quality business that will be here for decades. Berkshire Hathaway is fairly valued at the moment, I believe. Costco is a little bit expensive, I agree with you. Moody's, I'm not sure because of the large runway. And Hermes, a little bit expensive, yes. But you see, out of this list, TPL, FICO, Visa have fluctuating valuations. So you can just add them to your watch list, monitor them, do the due diligence, do the analysis of these stocks, and you monitor them from a distance. That's the best case scenario you can think of. You do the business right, the analysis right, and when we have a recession, maybe the next year, maybe this year, nobody knows. When we have a market drawdown for some reason, and the PE ratio for these businesses go down to a reasonable level, you buy them, and you hold them for many years. This is the best scenario if you want to compound your wealth for the long term. I believe this tier list gives you some interesting insights into thinking long term, building your portfolio, having great companies that you know really well, that are impossible to kill. They have a good management, they have a good moat, they have a good growth runway. This video had some good value, so if you get out of this video with some tips, I'm very happy. Please avoid the E tier, the D tier also, and for S, A, B, C tiers, be cautious with the price paid. Do your own due diligence, stay inside your circle of competence, and I'm sure you will do great things with your portfolio. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.